Let's give a warm welcome to our moderator, Daniela Egli, the Cyprus CEO and Group COO at Skilling. Daniela, the floor is yours.
Thank you. Thank you for the warm introduction. Hello, everyone. Thank you for joining us today in discussing a very important topic that affects many industries. According to the CDP, the Carbon Disclosure Project, the financial sector does not directly emit as many emissions as other sectors. However, its indirect emissions through companies they support, invest in, or loan to are 700 times higher than its direct emissions. It is said that with great financial power comes great responsibility. And with a total asset worth of $460 trillion, the global financial industry has the capital to make meaningful changes. So let's start with the basics. Let's talk about what sustainability is and what do we mean by a sustainable and inclusive finance. Suzanne?
Thank you. And thanks for having me. It was lovely to be here and great audience today. So we have got so much interested people in the room. It's lovely to see you all. So sustainability and ESG for good, fintech for good. The way we define it is that we're looking at all areas of financial services which make financial services a better place, a society a better place. So for us, it's about the environment, it's about social criteria, and it's about governance. And when we define what fintech can do in the sector, we look at it from a very holistic point of view. So we start out from the government's point of view, which is about boards, for example. How can boards give the direction for firms to allow companies to be more diverse, more inclusive, to have the right metrics in place so you can measure, if you become more sustainable as a business, if you become more green as a business. Then in terms of social aspects, it's about how to ensure that your workforce is empowered, that people know what are their carbon footprints. For example, are you carbon obese or not? That's a term I was never aware, what's my carbon obesity until I found fintech startups working in this space which measure your carbon obesity, for example. And the third area, of course, is climate change. It's the E of ESG, where we are now, as financial services companies, often not only that we want to do the right things, but also the regulators help us do the right things because we have got clear goals to meet. And as company boards, we will report on those goals to the regulators. So I think it's all going in the right direction to make our industry more sustainable and our companies more sustainable for the benefit of our society.
That's beautiful said. Thank you. Thank you. Yeen, would you like to add?
Yeah, sure. Thanks for having me here. What a great way to start with the definition of sustainability as well. I've just learned about carbon obesity as well. That's new to me. I'm gonna borrow UN's definition of sustainability because I think it's a lot of global initiatives span off that. So the UN states sustainability as meeting the needs of the present without compromising the ability of future generations to meet their own needs. So that's a really powerful, simple definition for sustainability. As Susanna mentioned, sustainability is complex, it's all-encompassing. To draw lines around it is very difficult, but I do have one critic of that definition is flawed in one fundamental way, and that is that we're putting current needs ahead of future needs. So, in other words, we're living at the expense of the future generation. So, the world has caught up with it. That's why in '97 you have Kyoto Protocol, which is our foundation for a carbon market system. And of course, you have Paris Agreement in 2015, where almost the whole world is coming together to commit to global temperature rise of less than or way less than 1.5 degrees. And in some ways, you got to look at sustainability as an environmental constant so that we don't shift the goalposts of the future. And because you can easily get clouded with the noise in economy or in social elements. So yes, that's sustainability to me.
Thank you. Thank you very much, Yeen. David?
Yeah, sustainability is everything to us at Vantage. You know, it's part of our ethos now. It's part of our culture. It's come from the management top down, and we really believe in it. We want to. Every company wants to make a profit, but we want to give something back to society. You know, it's very important. You know, we can really create a positive change with the brand that we have, and that's what we're trying to do here. You know, it's not just about climate change, but it's about inequality, poverty, diversity, injustice, and these are all the things we're trying to drive change and be pioneers in the fintech industry to do. You know, the fintech industry is a very pioneering industry. It's very nimble, has a great array of talent, and we can do a lot of change in this industry to really get this out there, that ESG is not just something that counterparties are demanding, but also employees are demanding now as well. You know, they want to join a company with an ESG policy. It's great for recruiting staff, retaining staff, and everyone now is thinking about the wider picture now and thinking about ESG.
Mm-hmm. Thank you, David. And in an effort to make a greater impact, you've also partnered with McLaren Racing. It became an official sponsor of McLaren Extreme E team earlier this year. And both partners share a commitment of sustainability, innovation, and performance. McLaren now competes in 2 electric racing series, Formula E and Formula Extreme E, and is recognized as a real champion of sustainability in the sport. And here we see the connection and between 2 different industries. Kim, as the Director of Sustainability at McLaren Racing, can you speak to us about what sustainability means to McLaren?
Thank you very much. Absolutely. For us at McLaren Racing, sustainability ultimately is about our license to continue to go and do what we and our fans love, which is to go racing. But in doing that, we really do need to ensure that we are giving back more than we're taking. And we can do that by getting our house in order, looking at what we're doing in terms of our own operational and value chain impacts in terms of the environment and social. We are a commercial operation, but also we have to therefore make sure that through our partnerships, which are so important, and through the platform of our fans, we are doing more than we're taking. So it's about how do we use the ecosystem of our partnerships to educate for and raise awareness to drive change. How do we look across the 5 racing series that we operate in, learn from those like the electric racing series that have been developed with sustainability at their heart, and use that learning to take back into the more traditional racing series and help drive change for future generations and to align with the values of future fans without alienating the values of our existing fans as well. So for us, it's social, environmental, and economic imperative that we do this.
Okay, great. That's very grand missions that we have ahead of us. What are the main goals? Yeen, you mentioned before the Paris Agreement. What are the main goals of the SDG and of an EU sustainable finance regulation? And does the fintech industry really have an impact in achieving these goals? And how?
Oh, I think let's start with EU sustainable finance. Now, the challenge with EU or UK in terms of sustainable finance, it's the biggest challenge is to mobilize funds, mobilize finance towards the green or sustainable transition. That remains the key challenge, that remains the key objective, and that's very much the strategy as well of all green initiatives or green sustainable finance policies. That's why 2019 European Commission came up with the Green Deal. So the Green Deal is about mobilizing 1 trillion euros as a block in this decade for green finance, but that's been hampered a little bit by the Russia and Ukraine situation. So, and that came, then Repower EU actions came about, which is essentially to accelerate our diversification of energy away from Russia. So just to start, the EU sustainable finance, that's the key objective. But if you come back to Sustainable Development Goals, there are 17 of them. And it broadly touches on people, it touches on social, environment, economic infrastructure, and institutional strength as well. So, but if you look at every component of SDG, and you just look at where fintech can come in, it's a resounding yes in many of those components, right? So let's take goal number 7 or goal number 8, which is decent work and economic growth, right? That is the natural space that fintech lives and it's vibrant, it's great. But if you look at the social side, goal number 1 is ending poverty. So fintech's role in addressing the unbanked community, right? World Bank is quoting 1.7 billion back in 2017 who are still the unbanked. So that's a critical role for fintech to be in, right? To access to financial services. And if you talk about health, which is goal number 3, again, another vibrant space for InsurTech to get involved in as well. So worth mentioning as well that fintech is dynamic, it's vibrant, you see it growing, it's exponential, it's great. With proper network infrastructures in place, fintech's advantage is that you get to the cost of entry is really low, right? Relatively, is very quick to implement solutions to meet sustainable goals, and you can roll it out very rapidly as well in comparison with traditional means. So it's a great space, and it's dynamic, and lots of opportunities there.
Suzanne?
Yeah, I want to agree with everything Yeen said, so it's very much a great space for fintech companies to innovate in. And I just wanted to give you a couple of examples, for example, in the insurance space, because next week we are launching the first film, which is called Fintech for Good, which will be a co-production by Fintech Circle and ITN. And what we will talk about and give examples about will be, for example, if you are flooded, like we have so many flooding emergencies now across the world, in fact. And if you imagine that your house is wet, your carpets, your floor is gone, it depends how quickly the insurance company pays you to start your life again. And in the past, those KPIs were measured from the time you submitted a claim to the time the claim was approved. But both things don't really make a big difference for you. What you want to know is from the time your house got wet to the time your money is in your bank account. That's a KPI which matters to you as a client of an insurance company. And so there are insurance companies out there, such as Flood Flash, working with Vitesse, who have got an insurance policy in place which, as soon as a certain water level is being reached, 5 hours later, people have got this insurance, get money paid in the bank account to, renew their houses. So those are examples where fintech does good things, clearly, where it really helps also hurricane victims, when hurricanes come. Again, we've got solutions where companies can take out those policies, but the payments get sent to all the employees of those companies. It's an employee benefit that you've got hurricane insurance. And I think that's what is so exciting about our industry, that we see innovative new startups really helping end consumers to deal either with the cost of living crisis, which we're all facing, or with the environmental disasters, and make it easier to survive at the end of the day. I mean, I think that's what Fintech for Good really can focus on and make a huge difference.
Thank you, Suzanne, for very practical examples. It's nice to see the connection between fintech and sustainability. Yeen, you mentioned that fintech moves very fast, but I feel like regulation might be something that sometimes puts some stops into the tracks. So, Martina, what are the main regulatory developments which drive our industry? And are these clear, helpful, and constructive to build alignment around common goals?
Sure, and a very interesting question indeed. I mean, I've been in this industry long enough on the ESG investing, on the ESG data analytics and index side to really see when and where there has been a paradigm shift. You know, when we started off, it was ESG, it was defining ESG, socially responsible investing. It became a debate that really had emerged and evolved from the traditional ethical investment space. And it's interesting, if you look at Islamic finance and other movements, there are still strong trajectories that there is alignment. And then interestingly, I've done a lot of work in Islamic finance and SDGs in the past, right? There's also the discussion around purpose, investing for good, Islamic finance considerations that actually take these debates to the next level. And then at the same time, you've seen the extension of ESG towards broader impact investment management theories. And that has all happened as well, probably has been happening in the last 5 to 10 years. But then we come to the other side of the equation. We have seen, that ESG has moved when and where disclosure and reporting is concerned, from voluntary to mandatory, from normative to regulatory frameworks, and ultimately from maybe principles to rules-based approaches and taxonomies, again, which of course underpin regulation. And it's now interesting to see, if you look at the EU Sustainable Finance Action Plan that we just heard, right, which had been set up with major prerequisites around sustainable capital flows, around better defining risk in the context of sustainability, and with a strong focus on long-termism in financial and capital markets. We have seen that the ambitions of the European Union and Commission were very clear. They wanted to define sustainability risk management and sustainable finance solutions for tomorrow. Again, they of course have developed now a very rigorous approach under the so-called Sustainable Finance Disclosure Regulation for investors. Article 6, no green, Article 8, light green, Article 9, dark green, in very simplified terms. And side-by-side developments around sustainability preferences when and where financial advisors and their clients under MiFID II is concerned, and of course the developments around the up and foremost green taxonomy. There were consultations around the social taxonomy that obviously followed suit but haven't really made it to the fore yet. And that layer now that has been created is really channeling, on the one hand, sustainable investment flows. And we're talking around $46 trillion, right? And potentially more than 53 by 2025, according to Bloomberg. They're channeling these sort of trajectories in Europe, and that's a small subset of the overall trillions, of course, but still a large subset, because I think European sustainable investment is at least half of that, even not more of that market, generally speaking. So they're channeling this towards regulatory compliant, rules-based approaches and solutions. And what does this mean in turn? And we're seeing the same developments on the corporate side, that there is the new Corporate Sustainability Reporting Directive, which comes into force by 2024. And by no means will that just hit large cap listed companies. The latest proposals we've now seen, there is a big development that SME companies will be required to also report in line with the Corporate Sustainability Reporting Directive, in turn, to meet the investment reporting and disclosure requirements, which very often are barricaded by the lack of information broader down in the supply chain. But that in turn will mean that whatever we are defining now going forward, also as impact, with obviously looking at the European or European Commission's influence and landscape, will somehow have to fall under classification / under the so-called EU SFDR Article 9, when and where investor reporting is concerned. And that, and this is my last note, of course, will have major ramifications for our industry, because all of what we have been doing in regards to investing for good, right, encouraging sustainable capital flows towards purpose, towards impact, SDG alignment, all of these terms we're discussing today, if and where these financial streams and capital flows are being considered and investors would want to meet regulatory requirements, they have to have the underlying transparency on how actually these, so to say, products and services ultimately are meeting the key prerequisites also of regulatory requirements. And this in turn, of course, will change again the tack for the entire industry that we are currently finding ourselves in. And I think a lot of that has not even yet been known, sunk through, or discussed.
That's very true. And are we talking about all this in the context of the European regulation? What are we looking at when we're looking at frameworks evolving outside of the EU in regards to ESG and sustainability?
Very interesting indeed. For instance, the US recently announced that they want to make climate risk related data and information / reporting also across the investment value chain when and where, again, investors / capital markets potentially are concerned, that they want to make reporting on this almost mandatory. You know, that's supply chain management oversight, as it's called. And that, of course, with a specific focus on climate risk management, will have those huge ramifications, because what we're discussing here, there's also a side-by-side movement alongside the standardization, harmonization of frameworks when it comes to climate risk management, for instance, under now the IFRS and ISSB, the International Sustainability Standards Board that's been formed, that will take lead in charge of assessing the financial materiality considerations when and where climate risk is concerned. You have literally now these developments that are looking into assessing scope 1, 2, and 3 emissions data. In turn, you have got regulation around the world kicking in on so-called TCFD alignment, which is the Task Force for Climate-Related Financial Disclosures. Some of these regulatory requirements have already become mandatory. Here in the UK, for instance, climate risk reporting for large cap listed companies, for public interest companies, for large public pension funds in alignment with the TCFD have become mandatory as of last into this year. And now we're seeing that the US and large major economies are moving in on that trajectory. On the one hand, closing the loops in and reporting gaps in the supply chain and making ultimately disclosures around the climate risk trajectory mandatory. This is massive.
Thank you, Martina. Yeen, would you like to add on the regulatory aspect?
It's very difficult to add, Martina. Very, very well covered. Now, scary, isn't it? Sounds daunting that you're going to be hit with a lot of regulations. ICF, we work a lot with regulators. We understand that space. We understand your space. Now, regulation, when done well, it should be helpful to economy, to the people, and to the environment. That's the purpose of regulation. So if I just break down the direction of what the EU's travel is and UK's direction of travel for regulations around ESG or fintech, you know, it's a lot of what Martina has already mentioned. But I'll just pick out the three things again, just to focus back on that, because those three things are meant to be helpful to the market, right? It's to support you, it's to give you a robust standard, a robust view, and looking at it in a holistic way and in a meaningful way rather than compliance, right? So, number one, taxonomy, right? The green taxonomy, which Martina just mentioned, that's just the definition of what consists or what qualifies as a sustainable activity or a transitional activity. That's number one. Number two is, as Martina mentioned again, disclosure, right? And specifically climate-related finance disclosure, CFD, there's a standard there. And CFD is somewhat different, right? It's version 2 of what carbon, a CDP, right, which is a voluntary reporting system. This is version 2 of it because CFD or TCFD, the Task Force for Climate-Related Financial Disclosure, is a standard that forces you to take account of your organization's future risk on climate. It's got 4 strands onto it. It's got governance, it's got strategy, it's got risk management, and targets, metrics as well. So that all those are there to help you think about your future scenarios as an organization and how you're going to meet your climate challenges. So it's, again, it sounds daunting, sounds scary, but it's there to support the market, it's there to help the market, and public sector is listening. They're continuously learning. And the third component of that is ESG benchmarks. So I've also heard from the other panel, the mood of the market at the moment is in the crypto space. You know, they're crying for regulation, they're crying for some security, they're crying for some stability there. So that's what ESG benchmark could do as well. I mean, it's to avoid greenwashing, and you can compare one institution's ESG with another without going to expensive ESG rating agencies. You know, you can get your AAAs and so on, but that's ESG benchmarking. So it sounds daunting, but it's meant to be supportive.
Yeah, Kim? Yeah.
Can I jump in from the perspective of a company who isn't listed, who needs to try and comply with these things and where it's useful and where the line might be? So I joined McLaren Racing 10 months ago and had to start almost from a blank sheet of paper in terms of our sustainability reporting and how we were going to convince our partners, those who were associated with us, that we're taking this seriously. So it was very useful to have references like the TCFD, to have regulations in place to an extent to at least create a level playing field. And our approach has been to be very open and transparent and honest about where we are and to use the guiding frameworks in place so that people can say, we're not saying what we're doing is what we've made up, it's aligned with standards. I think that's where it's very, very helpful, because it's been a little bit of a wild, wild west out there in terms of claims around net zero. I'm sure we can get into conversations about the risks of greenwashing and messaging in that space. But I think that it also needs to be appropriate. So depending on your industry, your organization, and who you're trying to influence, the role of regulation for us is very important, both from a consistency and ensuring that everyone's playing to the same rules. But you don't want to stifle innovation, which is one of the key things that we are about in terms of our partnerships and where we're trying to drive for innovation to solve some of the problems of the world. So we do need to get that balance right and enable regulation to stop the, continue with the analogy, the cowboy behavior, but also enable the pioneering and the innovation. And that's where in our industry, we would really love that there is some greater innovation. So we don't have to make a choice between innovation and performance and sustainability. They all go hand in hand. And I think that's where we'd love to get to.
Yeah.
I mean, regulations, benchmarks, and disclosures. I'm not fazed by it. I think it's going to just continue, and I think it's an opportunity, to develop and make a difference for your company. But it really has to also come from the financial regulators as well, from ESMA, from the FCA. They have to embed it into their culture as well to get the financial industry to make these changes. I say counterparties. If you're working with banks, they're asking questions now about your ESG policy, and it's not just saying, oh yes, we're doing something, we're offsetting and we're doing this. You also have to do it from within. You have to drive the change from within, empower your staff, get them to buy into what you're doing, and start asking questions about the counterparties you're working with. In the fintech industry, we're working a lot with data and data centers, and start asking questions to them. What is your ESG policy? How much energy consumption are you using? And start working with credible counterparties that have ESG policies as well.
Yeah, thank you, David. So we talked about all these daunting things when it comes to sustainability, but it's not all black and white, right? There is a lot of opportunities that companies can reap the benefits of once they decide to instill the sustainability value drivers. Suzanne, can you talk to us a bit about the opportunities that the companies can uncover?
Yeah, I mean, you're totally right. There are lots of opportunities, to number one, to aim for customers who want to invest, into ESG investment opportunities. And CMC Markets, where I'm a board member of, we just launched CMC Invest, where we aim and allow people to invest in a more environmentally friendly way, sustainable way as well. Equally, when I think about any other investment opportunities, people and investors want green investments. Equally, employees want to work for companies who take ESG seriously. And yesterday I was at Accenture, an innovation lab, where I'm a mentor. And we talked about that if you as a company take ESG seriously, you as an employee, you enjoy working for this company much more. So it's about helping your customers, helping your employees, helping your investors. And at the end of the day, your whole stakeholders. So if you do, and if you don't greenwash, but if you really do the right thing, it has got a long-term benefit. And I think the benefit comes in many ways. It comes short-term because you will gain the trust of your clients, the trust of your employees who won't leave to other firms, but who will be loyal to you. But of course, long term, with company valuations, share prices going up. So I think in our world at the moment, people and companies who take ESG seriously stand out. I think in 5 years' time, everybody has to do ESG. And it has to be like, when we talk about fintech, before we talked about fintech, was a relevant area for a few banks. Now everybody is a fintech company, otherwise there won't be a bank in 10 years' time, And so I think it's for all of us, it's a race to do the right thing as soon as you can, because if you do that, you will be rewarded by all your stakeholders. And I think that's what we all realize, and we start to realize, top down from boards, executive teams, to customers, and I think customers show us which products they appreciate to buy. And that's such an important reward, I think, for any company to focus on what our customers want as well.
Thank you, Suzanne. David?
Yeah, I mean, there's loads of opportunities with ESG. You can reduce your costs in the business with energy consumption. You've empowered your staff with diversity, and and you've got better people you're getting on board, and you're empowering them, and it can really help drive change in your company. So there's many opportunities with ESG. It helps with the governance of your firm, which what the regulator, the FCA, is a key thing for them, is actually governing your firm properly. So it's not just environment and social; it's also the governance as well. So there's many opportunities with ESG internally.
Thank you. So if a company is at ground zero right now, they haven't yet implemented a plan to become sustainable, and they want to take that step because they've attended our panel and they got inspired. What are those first steps that a company should implement in order to become sustainable and implement their ESG practices, best practices? Yeen?
Yes, and I hope you do. I think the most effective way we've seen time and time again is to start with the mandate right from the top, right? So a mandate coupled with a moonshot, really, a moonshot of where you want to be in your sustainable goals. So I mean, a very common one that you would see organizations start their moonshot with carbon neutral or net zero by 2040, by 2050, in alignment with the UK legislation. That's brave, bold step. That's great. But if you're not ready to do that moonshot, you can be honest with your organization as well. I'm not ready to get there. I'm not ready to commit. But at least commit to having a plan in place. Commit to, we're going to be market leaders here. We're going to take action there. It's going to be news coming out that we're going to take this serious. So start with the moonshot. Start with a mandate right from the top. Second point is, and this is a critical one, because as you start your ESG journey, you're going to hear about scope 1, 2, and 3, as Martina mentioned earlier on. That's critical because scope 1 is what fuel or what emissions you have within your organization, such as if your vehicles that you travel to work, you're burning fuel, or you're burning a boiler somehow in your organization. That's scope 1. Scope 2 is the energy the electrical energy that you're procuring from the grid. But scope 3 is the interesting part, is the complicated part, and is the part that is most critical. Scope 3 is all associated emissions in your supply chain, both upstream and downstream. So again, let's look at the space of fintech.
A lot.
So it's not just your front end services, right? You have a huge cloud environment, a huge data center that's powering your tech. So, and it's tough. It's tough because you don't own that tech, right? It's a service rendered to you. But you, as fintech players, you collectively have the strength, right, in your procurement, in your demands, in how you dictate your direction of procurement. That's a space that collectively fintech needs to be more supportive of, get on board, because it's a very energy intensive process, right? So pay attention to scope 3. Number 3, like I said, regulations are there, no doubt, but tools are there as well. There are a lot of tools and resources. We spoke about TCFD standards. We spoke about SASP as well, ISSB. There are also standards like, long ago you have ISO 26K for CSR. There's also science-based targets. So all jargons, it sounds like jargon to you, but they are all practical tools and standards to facilitate you in not just embarking on an ESG journey, but doing it robustly and doing it that it has it generates a real impact. And finally, I'd say make sure you start ESG with a ruler. Really, literally, you need to measure. You need to measure your targets. First of all, you need to measure your progress. You need to measure your success and measure your failures. Right? Be very honest with that. So the whole point about ESG, about what this is disclosure. It's not about covering. It's about disclosure. Your ratings go up further and further if you're disclosing well, right? Even if it's failure. Of course, if you do it, if you're conscious about the results, if you're measuring all the time, it can only go one way. You can only improve. So that's my 2 cents on how you would start.
David?
Yeah, if I was saying to any company to implement ESG, I'd either say you can do it on your own, or you can use external companies like ICF or PwC. Vantage, we've chosen to do it ourselves, and you really need to embed it into the culture of the business, which is what we've done. It has to come from the top down, from management, and choose your counterparties very carefully. Do your due diligence. We're delighted. We're partnering with McLaren. They're just like pioneering in this industry, and also UNESCO and UNHCR. So pick your counterparties carefully. Do your due diligence. Make sure they believe in what they're saying they're going to do, and not just jumping on the bandwagon and talking the talk. You have to really believe in it.
Yes, and can I just add to that? Having been through this process very recently for McLaren Racing, understanding who your stakeholders are, what's important to them, what's meaningful to them, and then where your impacts are as an organisation. We chose to apply the Global Reporting Initiative's materiality framework, because the problem with sustainability is it can mean everything to everybody, and you can try and boil the ocean, solve the whole world's problems, change your whole business. You need to focus in and start somewhere. So through that analysis, we've identified which standards we want to align for. So we signed up to the Science Based Targets Initiative because that's important to many of our partners. We signed up to the UN Sports for Climate Action Framework because as a sporting team, that's important to us. Diversity, equality and inclusion is so fundamentally important to the future of our team and our sport. So again, we set targets to get our house in order first, and then use our platform wider in terms of our targets there. And then it's about, you can't possibly do this alone. So partnership is so important. It's partnership in our context of with organisations and our partners like Vantage, but also with the racing series, with the regulators, those we need to influence to drive change. So I think it's understanding your landscape and then prioritising on the things that are going to make the biggest difference. And that's where data comes in. Understanding your data, understanding where the things are with your biggest impact and opportunity, and then putting those partnerships, those collaborations and those programs in to help move the dial is where you're going to then not feel overwhelmed by such a massive agenda and feel like progress is being made.
Thank you. That sounds a lot organized. Thank you for all the tips. There's one pitfall that maybe some companies will fall into, and it was mentioned before a couple of times, and that is greenwashing. So according to a 2022 study by ESG Book, 1 in 7 funds labeled sustainable had higher emissions than an average investment fund. So what is greenwashing and social washing, and what are the risks when we implement such practices? Suzanne?
I almost have to go to my Morgan Stanley days when I worked for Morgan Stanley in asset management. And greenwashing is basically, in summary, is if people say they're green but they're not, which means that they show and lie about their credentials, either consciously or unconsciously, and want you to think that it's a green investment while it's not. And of course, the hard thing is for us investors, if you think about us individual investors, how do you want to know if an investment fund, for example, which is called sustainable equity fund, if it's really sustainable or not? And nowadays, again, there are solutions out there which just don't go a level deeper. So they're not only analyzing the name of the fund or the industries they're investing in, but they analyze the composition underneath. So they analyze, the various investments the fund is doing, and if those companies, if it's an equity fund, for example, if they are, E, if they are S, if they're G, and how they are mapped, and those type of tools, I think, are really relevant because as an investor, the market is so complex. When we looked at how many ESG funds there are, these are tens of thousands of ESG funds globally who say they are green. And so we need to provide retail investors, sophisticated investors with tools to really segment what is correct and what's greenwashing. And I think that's an ongoing journey because the more our industry becomes sophisticated, the more there will be good players and bad players. And we just have to be alert. We have to be alert for the best high quality companies and help our customers to choose them. And that's, I think, any company who provides, fintech solutions or fund opportunities for retail investors has to really pay attention to help retail investors to choose properly green investments, which are not greenwashed, but which are proper investment opportunities.
Thank you, Suzanne. Martina, can regulation help with greenwashing in any way?
Very interesting question. That's what the regulation, at least also in the context of the European Commission's work, set out to do. It's also defined actually the different use cases. So when greenwashing as a debate started, very often, exactly to Suzanne's point, it was actually the discussion in the investment management industry. And we have seen that Deutsche Bank and a few other investment management firms have been under enormous scrutiny because they developed their own proprietary ESG analysis methods / methodologies that came under regulatory investigation, for instance, by the SEC and the BaFin, German equivalent, which of course has set the scene for an enormous focus on greenwashing and the definitions around ESG research, ratings, analyses, and the concepts that underpin this field, because quite commonly, ESG research and rating methodologies are just correlated. There's a study by MIT Sloan on this, at around 61+% when and where you're comparing the different methodologies assessing the same companies. And that information in turn is getting used by investors. Credit ratings correlate at 99%. The same study compared credit ratings, solicited ratings for entities by Moody's and S&P. So again, I'm not arguing about the fundamentals. One size in ESG, and we say that quite often, does not fit all. But it becomes clear that the discussion started on the investment management side because there is an aggregate confusion on what defines an ESG criteria, metrics, ratings / framework for assessments. From there, it has literally spread like a wildfire. And now you see the debate has moved also maybe side by side to the corporate sphere, because reporting in line with regulatory standards is no longer a nice to have. We have heard from the frameworks that are being launched in Europe or under the European Commission, similar developments here in the UK, by the way, not just FCA compliance in regards to climate risk management and oversight. There's sustainable disclosure regulation, which is becoming mandatory. There will be the equivalence for ultimately investors and corporations, and a specific focus on a new taxonomy. I'm on the All Parties Parliamentary Group on ESG here, House of Parliament, and we just had a meeting on this yesterday. The consultation is coming out as we speak. So ultimately, that means there is now an increasing focus on large cap listed companies, but taking again the European Union's example, by 2026, the coverage will also include SME companies. So the scope will widen from something like 10,000 plus companies in scope currently that are falling under corporate sustainability reporting directive towards more than 40,000 companies with a get-go. That's 2026. That's just a few years away. So again, maybe also to the point of what can companies do now? Absolutely. Define your materiality assessments. What are the criteria? And up and foremost, depending on jurisdiction, that's very often climate risk trajectories. Define the materiality around this. Define the methods and mechanisms. And then look and actually learn from the frameworks that are out there for corporate reporting. And map right now the information you have and data points you need to meet these reporting requirements. so that whenever investors are coming your way, and that will come up in investor relations discussions, as well as in a very short period of time when the regulators are demanding these type of reporting requirements, you at least are aware of what's ultimately becoming mandatory for both sides of the equation, investors and corporations. And that brings me to my last point. Greenwashing discussions from a regulatory perspective haven't stopped here. Look at ESMA, again in the UK, is following on the same trajectory. The research and rating methodologies and the providers in scope and question, that includes also quite commonly, right, fintech data providers. There is an enormous effort that's been made by ESMA and other equivalents to look into the transparency, methodology, the sourcing, the traceability, the quality management of information when and where ESG data is concerned. And that's been, again, a consultation on greenwashing that ESMA just launched this week. And it featured as a key point for their assessments/trajectories in their 2022 to 24 roadmap, which was launched earlier this year.
Great. Thank you very much. David,
I would
last
say,
words?
green and social washing is very damaging to your brand. It's not a road you should go down. You should, do as you say and work with credible counterparties and embed it into the culture of your business. As I say, it has to come from the top down in the business, and you have to just also do the simple things like empower staff, encourage them to bring your own bottle, to recycle, to think about everything that they're doing in a ESG way. So it's not just working with credible counterparties. It's also embedding it into your business that every decision you make has a ESG thought behind it, and to do green and social washing and just jump on the bandwagon is very damaging to your brand.
Reputation risk, yeah. Thank you, everyone. And unfortunately, we ran out of time. It was an insightful conversation. We could have talked for 2 more hours, probably. Thank you, everyone. I hope the audience got the very insightful tips on starting their ESG best practices. Thank you.